All right, welcome to the Explainer. Today, we're going to break down a really powerful tool that traders use, a tool that helps them find the hidden rhythm in all that market volatility. It helps you see when a stock is stretched way too thin and is just about ready to snap back. Okay, let's dive right in.
So it all boils down to this one question, right? When is a stock's price actually too high or too low? This is the fundamental question every single trader faces. And getting this right, that's the whole game. It's the key to buying low and selling high. But when you're just staring at a chart, how can you really know for sure? How do you separate that gut feeling from what the market is actually trying to tell you?
Well, see, here's the dilemma. Words like too high and too low, they're totally subjective, right? What I think is too high might be where you think the party's just getting started. But what if there was a way to measure this stretch in the price? Not with gut feelings, but with pure, cold, hard math. Well, you're in luck, because there is.
And that tool is called Bollinger Bands. Now, I know, you look at them on a chart and they might seem kind of complicated, but trust me, they're actually built from just 3 simple lines. And these 3 lines, they tell an incredibly powerful story about what the market's doing right now, and maybe even more important, what it's about to do next. Okay, so the first line, this is our anchor. It's really the heart of the whole system. It's just a 20-day simple moving average, or SMA. All that means is it's the average price over the last 20 days. You can think of it as the market's center of gravity, kind of like the fair value that the price is always dancing around.
Okay, next up, we need to get a read on the market's personality. Is it being calm and collected, or is it getting a little wild? Well, we measure that wildness, what traders call volatility, using a statistical tool called standard deviation. And hey, don't let the name scare you off. All it does is measure how far the price typically strays from its average. A small number means a call market. A big number means, well, things are getting interesting.
And this is where the magic really happens. It's actually super simple. We take that volatility measure we just talked about, and we add 2 of them to the middle line. That gives us our upper band. Then we subtract 2 of them from the middle line to get the lower band. And that's it. What you get is this dynamic channel that basically hugs the price.
So why 2 standard deviations? Why not 1 or 3? Well, here's what's so cool about it. By setting the bands up this way, we create a channel that, statistically speaking, contains about 95% of all the price action. Think about that for a second. That means when the price actually moves outside this channel, it's a pretty rare event. And in trading, rare events are often what signal an opportunity.
So this statistical boundary, this 95% rule, it leads us right to the core strategy for using these bands. I like to call it the rubber band rule. It's a really simple analogy, but it perfectly explains how to trade this snapback idea.
All right, so just imagine that middle band is a rubber band, just sitting there, not stretched at all. Now, when the price moves all the way out and touches one of those outer bands, it's like you've pulled that rubber band really, really tight. And what happens when you pull a rubber band too tight? It's about to snap back right to the middle.
And this rubber band idea, it translates into some really clear, actionable trading signals. When the price touches that upper band, you can think of it as being statistically expensive or overbought. That's a potential sell signal. And on the flip side, when it touches the lower band, it's statistically cheap or oversold. That's your potential buy signal.
Okay, let's put some real numbers to this to make it sink in. Imagine we've got a stock, and its average price, that middle band, is sitting right at $100. If the price rallies all the way up and touches the upper band at, say, $115, that's your potential sell signal. If it drops down and hits the lower band at $95, that's your cue to potentially buy. And in both of these trades, what's your target? A return to that $100 fair value right in the middle.
Now this snapback strategy, I gotta tell you, it works beautifully in the right market conditions. Until, well, it suddenly and spectacularly doesn't. And understanding when not to use it, that is probably the most critical lesson. It's really what separates the amateurs from the pros. So what happens when that rubber band just keeps on stretching? The secret is to stop just looking at the price and start looking at the behavior of the bands themselves. Are they squeezing together? Are they stretching wide apart? Because that is a massive signal about what the market is really doing underneath. It tells you whether that whole snapback rule even applies right now. The rules of the game can change, and the bands will tell you what.
It's all about the width of the bands. When they squeeze really tight, it means volatility is super low. The market is quiet, maybe a little too quiet. That's a sign that energy is building up, like a coiled spring, just getting ready for a huge breakout. But when the bands stretch wide apart, that means high volatility. A powerful trend is already moving,
and trying to fight it would be like trying to stop a freight train. So listen up, because this is the #1 mistake that trips up new traders. If the price is hitting that upper band, but the bands themselves are getting wider, you do not sell. In this case, overbought isn't a sign of weakness, it's a sign of incredible strength. Those expanding bands are like a giant flare, telling you the trend is strong, the move has power, and you should be on its side.
Okay, so how do we put all this together? How do we combine the snap-back rule with this huge exception about the trend? Well, it all comes down to a simple checklist. A checklist that'll help keep you on the right side of the market's mood.
All right, let's boil it all down into your key takeaways. First, the snapback trades, they work best when the market is just kind of drifting sideways, in a range. Second, when you see those bands get super tight, the squeeze, get ready for fireworks, because a big breakout is probably on its way. Third, if the bands are expanding, ride that trend, don't you dare fight it. And remember, what looks overbought can actually be a sign of a really strong trend. And finally, and this is super important, always try to use another indicator like an RSI or MACD just to confirm what the bands are telling you.
You see, by understanding how to use these bands, you're not just watching price anymore. You're reading the market's energy. You can start to see the difference between a market that's exhausted and ready to turn and one that's just getting started. But look, this is just one piece of the puzzle, right? You've just learned how to read short-term volatility. But what about the market's long-term direction? Are you ready to figure out how to read that like a pro? Because that's where the real story is.